In our last episode, we talked about Google now being back in favor of investors in AI infrastructure. But today we're going to be focusing more on the end market in SaaS companies.
All out destruction for enterprise SaaS in recent months. It has not been good.
It has not been good. And accelerated compute from Nvidia and the subsequent AI infrastructure build out has really shifted the upstream technology supply chain for enterprise SaaS companies. And that's part of the issue.
And yet, through it all, enterprise SaaS companies have continued to put up actually pretty consistent revenue growth numbers. For example, we have this chart from fiscal.ai illustrating Adobe, the big creative software and document management software company, is still putting up nearly 11% year over year revenue growth. Not bad considering massive AI disruption is currently eating enterprise SaaS. Which reminds me, Casey, we should probably mention fiscal.ai is having a Black Friday sale.
You can get 30% off until Monday, December 1st on any paid plan, including their enterprise plan, with the unique code here in the video and in the description. You probably know if you've seen our videos before, we use fiscal.ai every single day in our research, and they're a fantastic partner for you as an investor.
We're advocates of cutting through the noise, cutting through the narratives, and figuring out how businesses and industries actually work. Fiscal has been a great tool for us in creating visuals like this one to help cut through that noise and get a handle on what is actually happening. So check out that Black Friday sale, 30% off, fiscal.ai/CSI. Now let's talk about the narrative, Casey, around AI eating enterprise SaaS. This is another one of those like circular reasoning traps that investors get in. Investors are upset because AI is coming, enterprise SaaS isn't ready, it's doomed. And so enterprise SaaS invests in AI, and then investors are unhappy because, oh my God, what if we don't get positive return on investment from these new AI product R&D cycles? So, I don't know. I don't know that anything can top this type of circular flip-flopping of narrative. It's a little absurd, though.
There's only one person that could top this type of circular reasoning, and it's Dr. Ian Malcolm.
God creates dinosaurs. God destroys dinosaurs. God creates man. Man destroys God. Man creates dinosaurs.
Dinosaurs eat man. Woman inherits the earth.
Funny. This is not the first time that we've used Jurassic Park to illustrate business.
There's a lot of life lessons in Jurassic Park.
It's actually a business movie. It's not a dinosaur movie. It's about
Paying your employees.
Also that. Yeah. Lots of good business lessons. Okay, anyways.
Okay, back to Adobe.
Here's this timeline. And I think what's really happening here is twofold. First of all, in the 2010s, in the immediate aftermath of 2008 and 2009, there was a very low growth environment. Businesses were looking for ways to boost earnings per share without having to invest much money. And so cloud-based software was brilliant. And Adobe started making that migration in the early 2010s. They built a little data center in Hillsboro, Oregon, just outside of Portland. But they came to rely heavily on Amazon AWS to roll out new software. They started scooping up much more consistent revenue, more consistent profit growth as a result, and had very little in the way of big R&D cycles for new products as a result. Let's call it a CapEx. We've referred to it in the past with other companies as a CapEx holiday. Let's maybe even call this more like an R&D holiday. You can see the big run up there during the 2010s. And so the other half of this that lifted Adobe's stock price was multiple expansion. As that revenue ramped up, as earnings per share ramped up very rapidly, investors awarded higher and higher multiples to enterprise SaaS companies. Now everyone really just needs to get used to the fact that maybe there actually is an R&D cycle for software, and there's multiple contraction now for these businesses. PE ratios and price to free cash flow ratios are getting compressed, and that's okay. We do need to discount the fact that maybe this R&D cycle for enterprise SaaS isn't going to lead to the same amount of earnings growth as in the past, but nevertheless, this could spell opportunity. It seems to us that some of this fear really has been taken to an extreme here, and these companies almost not left for dead, but definitely left for some sort of future outcome where there's little to no growth left in them.
Now, there's nothing wrong with this cycle. In fact, it's a healthy thing to have, but we do need to have some proper expectations set for these companies. Adobe is an end market software provider, which means it's going to be at the mercy of its upstream supply chain, like data centers, AWS, and other semiconductor tech. With Adobe being in a period of elevated expense, this also does need to be discounted. Profit margins are down, and future payoff of current investments is an unknown. Adobe no longer remains in our portfolio. In fact, Salesforce is the only large enterprise SaaS company that we own, but we do have some smaller companies like Monday.com in our portfolio. And it too has taken quite the hit this year.
Yeah, as have pretty much every fast-growing small enterprise SaaS company that we own. We have our full research reports over on Semi Insider. Check that out if you want to see the stuff that we've been buying recently. But let's just mention this one briefly because it does illustrate the risk that does need to be discounted. Part of the R&D cycle for these enterprise SaaS companies is hitting free cash flow. So Monday.com's quarterly free cash flow was 91 million, which you can see was a big quarter-over-quarter jump from Q2 earlier this year. But on a year-over-year basis, it was only up 8% versus revenue, which was well in excess of 20%. So expenses are starting to mount as these companies develop new AI products. They have to pay sales and marketing team to get those into the hands of enterprise customers. All of that adds up. And this is the discomfort that investors are feeling right now. Expenses are ramping back up. When are we going to get actual profitable payoff? And if you're comfortable with this new cycle that has reemerged, that a lot of investors, us included, didn't have to worry about with SaaS companies in the 2010s, is the cyclicality of profits during major product R&D. This could spell opportunity. These stocks, by certain metrics, appear to be a pretty good, decent value for the long term, but you've got to be willing to strap in and take your lumps. And it's been some pretty big lumps as of late.
And another way you can accelerate your R&D cycle is make an acquisition, which is exactly what Adobe has decided to do with the company SEMrush. They're going to pay $1.9 billion for SEMrush, and that should close sometime in calendar year 2026. SEMrush primarily focuses on marketing with brand visibility and audience reach through generative engine optimization and SEO, or search engine optimization tools. So a nice addition to Adobe trying to build out their full stack software for creatives.
If you're an Adobe customer, maybe you'll get some extra marketing firepower in 2026 as a result of this. But we'll reiterate here, for a lot of these companies, it will probably be a bumpy road. But after significant sell-off in a lot of these enterprise SaaS names, this is where you can find some good opportunities right now, as a lot of focus has shifted this year to semiconductors, to the infrastructure powering the hyperscalers, and all the things related to that, the energy bottleneck and whatever. Software looking like it's down in the dumps, and maybe it's time to bottom feed a little bit.
Make sure you take a look at that offer from Fiscal.ai, 30% off any paid plan until December 1st. And come on over to chipstockinvestor.com and take a look at our new research platform.
Yep, that's where you can find all of our research, all of our articles, including on a different enterprise SaaS market. cybersecurity, we talk all about cybersecurity as well, and like some names in that department too. See you over there.